Hello friends, there was a great post on Twitter from Zero Hedge. I love that channel, always crazy stuff, but once in a while some really eye-opening titles, things that make you think what's going on. This was the case here. It's titled Housing Bubble Reblown. Last chance for a good price was 7 years ago. So what they're showing are, the CPI, hourly wages, and these two kind of, slowly mounting lines. And you have the Case-Shiller index, the kind of the repeat sales index, which I made videos in the past on, going up. And actually we can zoom in their chart here. You can see it's the peak right before 2008, the Great Recession, the bubble that basically was caused in part by a lot of bad housing loans. And you see it's crashing. And they're saying now, look at this, right? We're looking at similar heights. Well, it looks a little smaller here, but the last chance for a good price was right around here. Probably right. So my next question is this a good time to unload? Should we be unloading? Should we think that, real estate is at its peak? So what I want to do here, so I may not have all these answers, but one thing I can show you is how to do this chart on your own using the data ourselves. And this is the first step into understanding what's going on. At the very least, start charting it on a regular basis so you can keep track of what's going on and seeing, if you think that we're at the bubble and it's starting to, the air of that bubble is starting to come out and, it's a time to unload or not, right? Welcome to the Viral ML channel. As usual, my name is Manuel Amunategi, and this show will be classified under channels and finance, where you'll find all my other videos on finance, other things on real estate as well, usually with a Python Jupyter code. The link is in the description to find the code. Please sign up for my newsletter. Don't forget, it's right here, middle of the page of viralml.com. And subscribe to the channel, give it some thumbs up. It's always appreciated. Share it with your friends. So let's open up our trusted Jupyter notebook and let's get coding here. So we're going to need a variety of different data sources. So let me just go into, the first one is going down the S&P 500. So we're going to go to my favorite site, which is finance.yahoo.com for data. Simply go to finance.yahoo.com and type caret GSPC, and that will be the S&P 500 index. Hit the date range, max, done, apply, and download. It's that simple. It's going to download it to your local machine, a local folder. Make sure you put it in the same folder where you're running the Jupyter notebook, or do what like I'm doing here, have a path to where you're putting it if you're going to be running your Jupyter notebook from different areas, which is what I'm doing right now. So a quick recap, though I'm sure you're familiar with it by now. We're going to load it using the pandas read underscore CSV. You call it the exact same name as what it was downloaded on your local machine from finance.yahoo.com. We're going to cast the date as a date time. It comes out as an object. It's important to have it as a date time so Matplotlib knows how to handle it and to display the labels properly. We are going to throw out a bunch of fields, right? There's date, open, high, low, close, just a close volume. We're only going to keep the date and the adjusted close, which is better than the close because if there's dividends or any changes, it will be reflected. And we rename the adjusted close to S&P 500 underscore close. It's important here because we're going to be dealing with a lot of different data feeds. It's good to be able to separate them at the feature level. We are going to print the min and max date. Good to know to see what we have. And we're always going to sort the data. This is very important when you work with moving averages or you're mixing and matching different data sources. Some like to sort their data ascendingly, other descendingly. For moving average, do it ascending by date. Let the, you always want to start working on a moving average, calculating the average from the beginning and go to, to the later data. And we're going to do a tail. Data looks good. It's exactly the way we want. Next, we're going to get the Case-Shiller. So these data sets we're going to get from the St. Louis Feds. The links are in the Jupyter notebook. I think it's this one here. Click on the link and go hit max. Hit download and CSV, and that's going to download it, the CSV, to your local machine. Same concept as Yahoo Finance. Here I'm kind of doing the same thing, casting the date to a real date. I'm renaming the date as a lowercase date. I prefer that. And then we're sorting by date as well. And we are going to print the min and max of the Case-Shiller, and we see we have so data. So we have a lot more data, right? In the S&P 500 index. It goes all the way back to 1950, which is very generous. The Case-Shiller, we have it going back to 1987. We plot it, looks good. We're going to do the same thing. We're going to get the average hourly earnings of production and non-supervisory employees. I'm basically following exactly what the guys here, the chart they're showing here from Zero Hedge, which looks like it's from the St. Louis. It's basically the S&P Case-Shiller, which we just downloaded, the CPI, and the average hourly earnings. So exact same data sets that they have. We're going to be getting. So here you go. Here it is. The average hourly earnings of production non-supervisory employees. Same deal. Go max. Make sure you have as much data as you can, and go download it as a CSV. And you'll notice it's a beautiful looking, almost linear chart there. Same deal. So this is the same data source as the Case-Shiller. So we apply the exact same logic, and we see here we have a little bit more data. It goes to 1964. We print it out. Good. Finally, we're going to get the the CPI, for all urban consumers. Same deal, same data source, generously provided by the Federal Reserve Bank of St. Louis. Same deal, max, download to your local machine, yada yada. And we look at it, same thing, data from 1983 to today, and here it is, a CPI. So let me just double check something here. Yep. Okay, let's plot it. So now we have everything. Let's see if we can reproduce this chart, right, from that Zero Hedge posted. We're going to do a cutoff at 1998, which looks like more or less what they did. This looks like 1988. 1988. So we're going to do the exact same thing they did. I'm taking temporary copies of the original data set. So like that permits us to kind of play around with the data, do different date cutoffs without having to reload the data, reclean it and everything. And then I'm cutting it off by this date that we chose. And we're going to plot it. So plotting is fairly easy. We're going to put on a default axis. I'm going to put the S&P 500. Keep in mind, they did not put the S&P 500, so you can put it. You don't have to put it, whatever. I like to have the S&P 500. It's the barometer, the economic health of the world, and it represents a time map. We know exactly when the different recessions were, so it's always a good indicator of where we are and when dramatic things have happened. But then I'm going to open new axes. So we're going to do we're going to first of all create a subplot so we can have a perfectly sized plot for Jupyter notebooks, and we're going to get the figure and the axes. We're going to put the S&P date and a close. We're going to call it in blue. Put a label. We're going to then also do a title and plot a grid. So it's nice to have a grid there. We're going to open a second axis. Simple to do. You call ax.twinx, and anything once you've called, anything will be on that axis. So basically we're opening a secondary y-axis, and we're going to put the Case-Shiller. We're going to do it again. We're going to put the average hourly rate, and we're going to do another axes, right? So we have now 4 separate axes, and we're going to put the CPI. Okay, let's see it. Interesting, right? It doesn't look exactly like what this one is showing, right? But you'll notice there's a little detail here. It says 2012 equals 100. January 2012 equal 100. January 2012 equal 100. So they rescaled everything so that at this date everything is at 100, right? And so that's what we have to do. It's super easy. We're going to basically scale this a bit so that it's exactly like the thing we saw before. So simply, find out what kind of data did you have, January 1st? So for the S&P 500, January 1st, of course, was closed. So we have to go to the 3rd, and this is the price. And you simply do 100, right? This is the target price divided by the price. And you're going to give you kind of a factor, which then we're going to factor everything by it, right? It's a rough way of doing it. And then that gives us, we're going to create a new column called S&P 500 underscore close dash adjusted, where we're going to pass the close times the factor, right? So fairly simple. We're going to do this for everything. So let me run through this. Same thing for the Case-Shiller. Same thing for the CPI and the adjusted rates. And now we're going to plot it. The difference now is because we've rescaled everything to 100, to that 100 point. We even rescaled the S&P 500 to 100, which is funny because they didn't put it, and they certainly didn't do that, right? We did it for the S&P 500. We now don't have to call any more separate axes. We can put everything on a single axis. So we only have one y-axis, and it's all been scaled to be January 2012 to be at 100, right? So here it is. We're going to plot them all together. And let's see what we have. Ooh, look at that, right? So ignore the blue line, but look at the red line. Actually, you know what? Let's remove the blue. Title we can keep. There. Let's compare, right? It looks pretty much similar. You can see that point right here. That point in time is obviously, right, 2012 January, right? So everything was scaled exactly at 100, and here it is, right? So let's put back the S&P 500, because it's really it feels like I'm flying blind without the S&P 500. It's my favorite index. So what do we see here, right? We clearly see, right, the Case-Shiller index, which is a repeat sales, meaning it doesn't do any new sales. It only does sales that have been done at least once or twice in the past. And then and this is for like a national, so it's for all over the country. And you can see that, right, the prices were going up. It started going down, right? We had this nice period of down while the markets were still peaking. 2008 was still peaking. People were still, going, wow, we're going up. The Case-Shiller was already going down. Today we see the same thing, right? It bounced. So this is the price. So this is where the title for the Zero Hedge post was: housing bubble reblown. Last chance was 7 years ago. So obviously they're referring to this point in time was when it was good to buy. That's why we went back to that date. And here we see it is going back up. So you have that but if you look at it, right, it doesn't feel like a crazy bubble here. It feels pretty linear. These are the latest, the April Case-Shiller numbers came out, and it's going back up, right? You can see the slight up going on. And look at the markets, right? They're keeping on going. It just doesn't seem like there is so I would say this probably was a good time to buy, right? In hindsight, it's very easy to say. Are we looking like, should we unload real estate? From looking from the charts, looking at the Case-Shiller that's pointing upwards, I don't see it, right? I don't see this imminent crash going on. One thing we can do is we can add the VNQ. So the VNQ, I like it a lot too. The difference with the Case-Shiller is the VNQ is the Vanguard Real Estate Index, and it's also kind of talks about it's a value, it's an ETF for real estate. The nice thing about the VNQ is you get it on a daily basis. It's not like the Case-Shiller, which is a report and you have to wait a quarter to see it, right? Like right now, they just released recently the April numbers, so it's a bit delayed. So same thing, you can download it to your local machine if you want to play around with the VNQs. So we are going to do the same thing we did with everything else. We're going to download the VNQs, clean them up, and then we're going to apply the formula, right? We still want to go to 2012 January. We still want to go 7 years ago, right? This is what they said 7 years ago, so that's why we need to go there. And apply the factor to it, yada. Let me run through all of this. And we're going to plot it. Now, we're going to plot, instead of plotting the S&P 500, I'm going to swap it with the VNQ. So I can see my label here is wrong. So let's go like this. Perfect. And actually, I'm not showing the label. But as you can see here, the VNQ, just like the Case-Shiller, right, is showing this run up. So you can compare, right, the VNQ with the Case-Shiller. It's too bad that the VNQ, we don't have it going back a little bit, right? But it was kind of accelerating, right? The rate of change was accelerating right at the peak, and it went down. It went down hard. And now here we have this more linear growth going on since 2008, so past 10 years, 7 years, whatever. It's just been kind of going straight. We have, and here we have kind of, a little bit accelerated. VNQ is accelerating, like in the last run here, it just kind of shot out, just kind of like what the S&P 500 is doing. We can go back here. It kind of shot up to 3,000. We're seeing the same thing here. So, what point are you? Is it a good time to sell real estate? Well, obviously, in hindsight, it would have been right around here, right? Right around 2007, beginning 2007 was a time to dump real estate, right? It's clear here. This is still going up right around here, right? But when do you know about it, right? Well, you probably knew about it when the Case-Shiller was going down, right? So right around here, VNQ is going down. This is when you should be suspicious, right? When you have this beautiful, shape, it is turning around, and that's probably when you can realistically tell that there is some problem in the markets. I'm not seeing that here. I'm not seeing that in the VNQ, right? So I would say it's not quite a time. Again, I'm not giving any advice. This is just purely education, entertainment, and about charting the markets, and especially about teaching you and everybody to get in the habit of getting this free data from these different great sources. It's free, it's accurate, and plot things on a regular basis so that you're not surprised. There's no surprise because you have access to the data and you can tell what's going on. So For those who are interested in looking at these kind of fundamental data, don't forget I have my book here, the little book of fundamental indicators. You can find it on Yahoo. Just put on Amazon. Put my first and last name. Here it is, right? A little book where we talk about the Case-Shiller index, CPI. We talk about unemployment, the S&P 500, the VIX, the fear index, all sorts of good things. And I also have a new class on Udemy.com right here, fundamental market analysis with Python, where I talk about a lot more things. And you have the videos and you have the code to go with it. So if you're interested, check it out on Udemy. You can also put my name, first and last name. I have a few classes on there, but that's my latest class. It just came out a few days ago. Thanks for watching, and give this video some thumbs up.